Okay. All right. So let's start the mock. Couple of these questions. So let's see how you look at the first four. Let's go straight to the first question. So number one says, in relation to hedging interest rate risk, which of the following statement is correct? What say you? Would be the last in terms of interest rate. So it says interest rate options allow the buyer to take advantage of favorable interest rate movement. Yeah, because they have a choice. So if it is unfavorable, then of course they will just allow it to lapse. But if it's favorable movement, then they would exercise. So it would be D for number one. Question two now. What is the discounted payback period of this investment? You'd have to discount these at the 10%. So 0.909 times the 130, 0.826 times the 130, 0.751, 0.683. Yeah. Number one, says in relation to hedging interest rate risk, which of the following statement is correct? That one?
You said the interest rate of the bank.
Correct, yeah. Because you see the first one, that's matching, that's not smoothing. So the name there is incorrect. The other one, interest rate future contract grant the buyer the right but not the obligation. No, that's options. Options give you the right but not the obligation. Futures, you're contracted. You have to go ahead and proceed with that transaction. You don't have a choice, right but not the obligation. Mean that you can, but you can decide not to know. Futures are binding. And then it says forward rate agreements are exchange traded contracts. No, that's not. FRAs are actually over the counter contracts, right? So that's why those wrong. So the first one is matching is it actually defining and not smoothing. The second one is defining interest rate options, not futures, because futures you don't have a choice. The forward rate agreement, they are not exchange traded contracts, they're over the counter contract, they're OTC, right? And then so D would be the other one. Options give it, you can take advantage of favorable movements. If it is not favorable, then you just allow it to lapse because you have the right, but not the obligation. That's what options are. The second one now, what is the discounted payback period? That one is pretty much maths. So you discount you have your 450 and then you discount the others 0.909, 0.826, doing all of those lovely stuff until you get the correct running balance at the end. It asks you to calculate the discounted payback of this investment based on the information you have there. Your answer would be D. And that's if you put the numbers together, right? Like what we have on the screen here. So pretty much you'd have to discount them. So you have the 130, 130, 130, 130, 130. You have all of those, yes. But then you have to discount them and then see what the running balance is. So times 0.909, 0.826, 0.751, etc. And then you do the running balance. You'll notice that in the fifth year is when you basically clear the money. So it's really what you need over what you receive. So 38 over the 81.47. So D is the answer to question 2. Question 3 now. The following statements relate to market efficiency. It says if an analyst taking a chart is approaching an efficient market would not be able to make any statistically significant gain. All right, and the next one, if a market is efficient, any type, share prices are set to follow a random walk. What say you? What do you say for this one? Who said? Both of them are correct actually, so you don't really need to pressure it. So the answer would be A, because let's look why. If it is efficient, you can't make no gain because it means that there's no insider trading possible. The market efficient, then it reflects what the share price reflected. So no matter who have whatever information, because the share price already reflecting all information possible, right? The other one, and then it says, so if it is efficient, then it's going to follow a random walk, meaning that you can't guess estimate what it may be. Because if somebody could estimate, then they can decide, all right, we're not going to sell now, we're going to buy some now. Yeah, but if it's efficient, then nobody can do that, right? Okay, so both statements are true, so that's Apple. Question 4. What is the likely impact on an economy of a policy of high interest rates? What is the impact? One alone, two, both, none, right? So impact, high interest rates, an appreciation of the currency's exchange rate, yeah. An increase in customer expenditure, of course not. Interest rate high, people can borrow less, right? So only one alone. So A, Apple would be the answer for question 4. All right, let me see if they give us some here. Save my explanation. What did they say? By encouraging capital inflows, higher interest rate will tend to lead to an appreciation of the currency's exchange rate. Right. And statement 2, yeah, no, statement 2 false. Right. So generally, in this instance, because interest rate high, what's going to happen is that people are now pretty much going to be getting more money in, right? So let's use a real world example. If interest rate high, generally consumers are going to borrow less, right? So they will borrow less. Now, when they borrow less, because remember how inflation works, right? Inflation works when there's too much money in the economy, right? If interest rates are high, a lot of money is not going to be spent. So the demand is not going to be high for that coin. The demand itself, no, because it's not spend, the demand actually going back. No, money not there. Nobody not spending money. No, people want the money. So the banks and everybody else, the borrowers, they want the money, not true. Because all of them keep money because interest rate too high. So, but money need to be spent, right? So the fact is, if money need to be spent, they must go find the money at some point in time, and they're willing to pay what they're going to pay for the money. So that is why your money will get stronger now. That's why the currency is going to appreciate, because nobody is spending, none is there, and because other people, businesses. So you and I, we're just a small man that keep up with money, but the businessman need to do business, right? He need to do business. He need to build, doing real estate, he need to do all different type of stuff. So he's willing now to get that currency at any cost. So, right? So he's willing to get it at any cost. All right. So the next one now, number 5. Which of the following statements concerning shareholder wealth are correct? Did you reach here? Or should I take a little break? Did you go through this one? Hmm? All right. All right. So which of the following statements concerning shareholder? So first one. Wealth of shareholders is increased by dividend received and capital gains on shares owned. All right. Next. Share prices may increase irrespective of the decision of managers. Okay. A rise in earnings per share will cause an increase in shareholder wealth. What you say about that one? You say the last one or the one was sketchy, right? A rise in EPS. EPS have to do with profit. Profit is something you can manipulate. So that not really necessarily going to feed into say the share price will go up. Because you can manipulate your profits, right? So a rise in earnings per share will cause an increase in shareholder wealth. No, will cause. It may cause, but the will cause is too absolute. But the first one, though, definitely, dividend and capital gain actually increase the shareholder wealth. Share price may increase, no matter what the managers do. It might actually increase. So it didn't say will. So that word in number 3 is what throw off number 3. So 1 and 2 alone. Apple would be the answer. Because yes, it may still increase. No matter what them decide, it may still go up. Not saying that it will go up, but it may go up. Number 3, the will. A rise in EPS will cause an increase in shareholder wealth. No, it may cause an increase in shareholder wealth. Earnings per share is something that can be manipulated. It's based on profit after tax. The dividend, your depreciation policy, your amortization policy, your bad debt policy, all of those things. You can decide to adjust those so that your profit look good. Yeah, so you can decide that here what, let me move from straight line to reducing balance. Let me change my amortization policy, right? You can make all of those decisions. You can say, here, let's reduce the provision this year. Let's reduce it so that the profit look good. So all of that can be done. And that doesn't mean that the shareholder wealth increases. You just manipulated profit. And you just want the EPS to look good. So the whole word there was the will, because the will is an absolute term telling that once EPS go up, shareholder will go up. No, not the case. It might go up or it may not go up. All right, question 6. Question 6. So question 6 says, in the not-for-profit, which of the following could be used to describe effectiveness in this context? Effectiveness, avoiding waste of input. No, really and truly, effectiveness is if you're achieving the objective. The closest word into that is what? Be as in boy. Effectiveness is really, am I achieving my objective? To achieving agreed target, that's the closest one there. So be as in boy. Question 7. Which of the following statements about money market instruments are true? A company can use the money market to manage exposure to foreign currencies. Number one is definitely correct. So we know say C can be in the answer. You can use money market hedging for foreign currency risk. All right, so 1/2 it in the answer. Good, let's go. The next one. Options are interest-bearing instruments where the investor receives face value plus interest at maturity. No. Options is some is are instruments where the investor receives face value plus interest at maturity. No, because options are something you can either exercise or not exercise, right? But this is guaranteed. Number 3, certificates of deposit, CODs, are non-negotiable. So what do you think of the answer here? So what do you think of the answer here? So one alone, because CODs are negotiable. All right, so one alone. A as in apple would be the answer for number 7. Now question 8. Which of the following statements about gearing are true? First one, financial gearing refers to the variability of returns caused by debt interest, and therefore financial risk is often measured by the debt to equity ratio. Oh, yeah, that sounds good. All right. Operational gearing refers to the variability of returns caused by the fixed cost of the business operation, and therefore business risk is best measured by operating profit to sales. That sounds sketchy. So the first one sounds good, the second one doesn't sound good. Let's see how they explain this. So that is correct. So C is right. So statement 1 is true, statement 2 is false. Operational gearing refers to the proportion of costs that are fixed. One approach to measuring it is contribution over PBIT, right? Contribution only contains variable costs. PBIT is after both variable and fixed costs. A higher ratio indicates a higher proportion of fixed costs. Yeah, that whole business risk discussion sounds like going in CAPM, and that is nothing to do with this one. So C is the answer for question 8. All right, let's have some calculations. So we give some minutes to try work some numbers and then we go through this. That's number 8. Let's have some numbers. So stop at question 8. All right, so question 9. Lots of information, but what is what is the optimal order size? Assuming that RR is chosen as the sole supplier of shower units for SK. So they're asking you for the EOQ basically, right? So with all this information, they say RR is located on the, it has offered to supply each shower unit at that, with a transport charge of that. It has guaranteed such a regular and prompt delivery. Okay, will not be necessary to have safety and all of those lovely stuff. Okay, so what we do know, they decide that the annual demand is 10,000 units. True? Yeah. The ordering cost, 200 per delivery, basically, right? The holding cost. It says the cost of SK of holding one shower unit in inventory for 1 year is $4 plus 3% of the purchase price. So $4 plus 3% of 400, right? So 3% of 400 is 12, 12 plus 4 is $16, right? So that's the holding cost. So we have the holding cost, the ordering cost, the annual demand, boom, that's all we need. Drop that in the EOQ formula, square root of 2 COD over CH, and that's it. So 2 times 200 times 10,000 over $16, find the square root of that, and you get 500. Right, so that would basically be it for question 9. Question 10. Yes. Mhm. You are the ordering cost. 200 per delivery. So every time you order, that's what you pay every time you order, yeah. Yeah, but every time you transport, every time you order, you have to pay $200. So them using those particular words, because the delivery is not based on the amount, you know. So even if them deliver one item at $200, they deliver a million items, $200. So basically every order you place is going to cost you $200, regardless of the size. So question 10, which of the following statements concerning financial management are correct? One, it considers how investments will be financed. We know that because we did that part, okay? Because we look at capital rationing and all of that. So it does look at that. Number two, it considers how much profit should be distributed to shareholders. Yeah, it also look at dividend policy. So yes, there's dividend policy. Do you do everything? Do you do some? All right. Three, it presents a picture of past operations and the state of no, that's a financial accounting. Yeah, that's the balance sheet and income statement. That's financial accounting. There's one and two only. So A, Apple, would be the answer. All right, question 11. What is the geometric average dividend growth per share for HPCO over this period? So it's so unlike the growth rate. And yeah, geometric average dividend growth rate, the same formula we use. So let's look at what they're talking about. HP has 12 million shares in it and has just paid an ordinary dividend of 3.6 million. Last year, HP implemented a 1-for-2 rights issue. That's one new share for two existing. 3 years ago, the dividend was 1.6 million. So what they needed to do now, what was the dividend per share in each case, right? Because the 12 million shares, 3.6 million, that would mean that that's like 30 cents. No, 3 years before you give 1.6 million out, but how much shares was there? Because it was one new share for two existing. So you have to go work backwards. So, okay, that looked like it was 8 million shares, right? 2/3 of 12, yeah, 8. So that would mean then that's 20 cents. So it's moving from 20 cents to 30 cents over 3 years. Then you use the dividend growth model. So right, so see we have the numbers here, same thing, right? So 3.6 over 12, 30 cents. 3 years ago, before the rights would be 2/3 of 12, 8 million. So that means the dividend per share 3 years ago would be 1.6 over 8, 20 cents. So now we can know the growth rate, the cube root of 0.3 over 0.2, and then you minus 1, giving you 14.5%. So the answer there would be D as in dolphin or dumpling. All right, so yes, work some more numbers. So we'll pause again. Try to do some workings. And then let's go through another set. All right, so let's look at question 12. So question 12 says BCO has a cost of equity of 10%. The equity risk premium is estimated to be 6% and BCO's equity beta is 1.2. Now, BCO has a debt beta of 0.2, the rate of cooperation that is 20%. What is BCO's post-tax cost of debt? So then giving you all of those to find a missing number, and let's go straight into it. Now, normally the CAPM formula is KE equal risk-free rate plus the beta, right, times market return minus the risk-free rate. Cool. Now, they don't give us the risk-free rate. That's what we have to go work out. But they did tell us the cost of equity is 10%, and tell us the beta is 1.2, then tell us the risk premium is 6. The risk premium is what is in the bracket, right? So the risk premium is the difference between the market return and the risk-free rate. So then tell us everything except the risk-free rate. So if we go solve it, 1.2 times 6 is 7.2. So 10 equal RF plus 7.2. So RF will equal 10, carry over the 7.2 equal negative. 10 minus 7.2, the risk-free rate going to be 2.8%. That's what the risk-free rate is going to be. Now, using the debt beta, they tell us now, but debt carry a risk of beta measures risk, right? So they said the debt beta, the risk of the debt itself is 0.2. So KD pre-tax, we have to estimate it now, so it's going to be 2.8 plus 0.2 times 6, because again, the 6 is the risk premium. So that's going to tell us that is 4%. Now, then have a backward tax. We just did net tax. So 4% is what the cost of debt is before you deal with tax. Get the cost of debt times 1 minus T, 1 minus the tax rate being 20%. That would mean that your answer is B as in boy, because that would be 0.8 times 4, which is 3.2%. Question 13 is addition and subtraction, but doing the formula, so I'll just show. Inventory days, to get that, you would do 77 over 140 times 365. Receivables days, it would be 56 over 280 times 365. Payables days would be 42 over 140 times 365. Payables is the only liability, so you add the two and subtract the payables, and then that will give you what the working capital cycle is, 164.3 days, which is C. All right, so that's for number 13. Question 14. The following statement relates to the money market and capital markets. Money market instruments are only traded over the counter between institutional investors, and the other one, capital markets are markets for medium term and long term finance. The problem with this one is the one that it says it's only traded over the counter between institutional investors. Oh man, companies can trade in the money market as well. So that one is wrong. So statement 2 is true, statement 1 is false. So B as in boy, that would be the answer. Then question 15, so we can stop at that one and give you time for the others. Question 15, a company has issued a 12% irredeemable bond quoted at 95x interest. The rate of corporation tax is 30%. What is the post-tax cost to the company of this bond? So 12% irredeemable is a $100 bond. So it's $12 interest you're paying on the bond. It has to be net of tax, so it's going to be $12 times 1 minus 0.3. So $12 times 0.7, which is 8.4, over the market value X interest. So 8.4 over 95, and that's going to give you what? Probably 8.8. So, right? 8.4 over 100 would be 8.4. So 8.4 over 95, that has to be the market value X interest. How we get it $8? How we get that? As we said, $12 times 1 times 0.7. The 0.7 is the 1 minus tax. Right? So $12 would be the interest, because $12, 12% of 100, $12. But net of tax, because it's a post-tax. So $12 times 1 minus 0.3, that gives you $8.40 over the market value X interest, which is 95. So $8.40 over 95 would give you 8.84%. So that's A as in apple. would be the answer for question 15. All right, let me get into section B. So I give you a few minutes to start. Just reading through that and let's go through an exit. All right, so let's look on the information. Question 16 says, what are the trade receivables and trade payable days for year two using average balances? All right, so we'd have to work it out for each. So it says average balances. So we'd have to do something like this. So the average receivable is going to be, of course, well, to do it this way. But 700 plus 750, so it would be 700 plus 750 divided by 2, so 725, right? So you're going to use it 725, and of course, they tell you what the sales per month is, but the annual sales, you're going to have to put it over. So it would be 270 times 12, whatever that is, 3 point some million. So 725 over the 3 point some million. And the payables, similarly, 650 plus 595 divided by 2. And then the cost of, over cost of sales, the cost of sales being the 210 per month, so that's 210 times 12, whatever that gives you. So basically, for question 16, your answer should be D, because 725 for that is 82 days. And for the payables, it's 90 days. Question 17, the net working capital finance required. Well, that's just the current assets minus the current liability in dollars, right? Excluding cash. The net working capital, we're going to exclude cash. So inventory plus receivables less payables. So 468 plus 750 minus 595. So the inventory is 468, receivables 750, payables 595. So 468 plus 750 minus 595 going to give you 623,000. Now, if the sales rise by 20%, then the net working capital also need to rise by the 20%, right? So it would be 20% of the 623,000, giving you 124,600. Of course, your answer being 17A for number. So for number 17, the answer is A. Number 18 is theory. FKP's cash operating cycle is longer than the industry average. What might this indicate? Right? So it's longer. So it means that they pay their supplier more quickly than the industry average. That's pretty much what it may be indicating, that they're paying very quickly. Persons delay payment, they don't delay their payment to their supplier. Question 19. FKP is concerned about over trading in the future, which are the following is a symptom of over trading, right? Which are the following is a symptom. The operating cycle falls. The payment period to creditors shorten. No, man, you struggle to pay them when you over trade. Inventory turnover slows down. That is correct. Let us pay more quickly. No, you not pay them. Let us not pay more quickly. Because you're giving credit to people who might not pay you anyway, because you're just trying to do too much business with the little bit of capital you have. So C would be the answer to question 19. And then question 20. FKP decides to offer a 5% early settlement discount that 75% of customers take up. The impact of this discount is that these customers will pay a month earlier than they're currently paying. FKP pays 8% per annum for its overdraft facility. What impact will the discount have on the cash operating cycle and on the reported profits? Right? So both of them going to actually reduce, and you can actually use some numbers. I could see them using some numbers there. So both the cash operating cycle and the reported profit is going to reduce. But even without using numbers, why would that be the case? Because at the end of the day, as you notice, your customers pay earlier, quicker. So that gets just smaller. So that figure gets smaller. So the cycle will get shorter. Reported profit is going to reduce. Why it going to reduce? Because the discount expense is not higher. Because now you're giving discounts. Or you can say a revenue getting less, so your profit is going to get less. Because some that was revenue before end up taking a discount off of it. So B as in boy would be the answer. Both of them reduce would be for question 20. All right, so give some time to read the other set, next scenario. Let's read that and then let's go through that next file. All right, so question 21, which, okay, that's theory. All right, so question 21. GSF is concerned that the cash it is due to receive from overseas sales will not be as expected due to exchange rate movement. What type of risk is this? Translation? No. Economic? No. That's long-term. Business risk? No, man. Not a vocabulary or anything like that. Transaction risk? Yes, on that particular transaction. So D as in dolphin or dumpling. That would be the answer for that. Question 22 now. Calculate the amount of dollars that GSF will expect to receive if a forward contract is used. So this, as they anticipate, is that they're expecting 3 months to receive 1,650,000 euros. Now the 3-month forward rate is between 1.2533 and 1.2601. But as we know, the bank always wins. So what are they going to receive? Right? So how is this? Because it's a calculate the amount they expect to receive. All right. So what are they going to receive? Which one are the rates? Because we know it's a forward rate, it's a forward market they ask us about, forward contract. So is it 1.2533 or 1.2601, whichever one you use, is the one that they're gonna receive the lowest amount of money, least amount of money. So what's your answer? When you work out the numbers, what you get? So the 1,650,000 gonna be divided by which one of those? The 1.2533 or the 1.2601? Do your division and tell me what your answer is. Is it A, B, C, or D? Hmm? Yes. A as in apple, that is correct. 1309,420. That's where the bank wins. If you use another, collect more money now, so the bank is not going to give you more money than what they think you deserve, even if you deserve it. Number 23. Which of the following statements are true of forward contracts? Which of the following? They are binding contracts. Yes, we spoke about that. They can be sold on to no. That's it's locked in. Next, they fix the rate for a future transaction. That is correct. The rate is actually fixed. Like we just saw the forward rate. It is fixed. They are flexible one. Oh no, they're locked. Once that's it, there's no flexing again. It's locked. So 1 and 3 alone. So B as in boy. That would be the answer for question 23. That would be the answer for question 23. Okay. So we did 21, 22, 23. Okay, so we said D, A, B. All right, all good for that. Now 24 and 25. 24, based on that, that's straightforward. It says, which theory can be applied to calculate forward exchange rate using nominal interest rate? So that give it up. Interest rate parity theory. Question 25. Calculate the amount that they'll expect to receive a money market hedge is used. So it's a foreign currency receipt. So they're going through the steps. The steps is borrow foreign currency today. The amount to be borrowed is the expected receipt over 1 plus I. The I is going to be the borrowing rate overseas prorated. All right, good to go. You know that. Then step 2, convert at spot. What rate we're going to use? The rate at which the bank always wins. So the least amount of money the bank is going to give you. And then step 3, invest at home. What would be the result? Would be step 2 times 1 plus I. What is the I? The deposit rate at home prorated. So the borrowing rate overseas, 1.4%, but prorated for 3 months, 0.35%. What is the deposit rate at home? 2.6%, but that is prorated for 3 months, giving you 0.65%. So those numbers done, then your answer would be B as in boy for question 25. So that would be the solution. Question 25 would be B as in boy. Again, give you a few minutes to read through the next five, and then we will go through the next five. Questions 26 to 30. All right, so let's see what 26, what these have in store for us. 26 says, on a realizable value basis, what is the net asset valuation of HSD Co? What is the valuation of HSD Co? You just look on this one, because this one is adding and subtracting the relevant stuff. So let's just go straight to this one. It says the book value of HSD's net assets attributable to shareholders is 4.25. 3.5 plus 1.25 minus 0.5. However, there are some adjustments in the notes. This figure should be increased by 0.75 million to 5 million to allow for the excess of the realizable value of the non-current assets above their book value, and then 0.25 million deducted for irrecoverable receivables, making a total of 4.75 million. So D as in dumpling, that would be the answer to that question. Let's just go straight to 27. We're going to deal with 27 for the PE valuation, taking the 2.5% growth figure that was given. Next year's earnings would actually be 0.738 million. How we get that? It was 60 cents per share. That was the EPS, and it's 1.2 million shares. And then it increased that by 2.5%. That's how we get the $738,000. Now, VVS PE ratio is the market value over the earnings. 450 over 45 was 10. That was their PE ratio, 10. Applying the PE ratio that currently applies to VVS to the estimated earnings, as we say, of the 738,000 would be 10 times 738,000, which is 7.38 million. So Apple would be the answer for question 27. So Apple will be the answer for question 27. Now question 28. Let me just look back on the question itself. All theory. Why is it not appropriate to value a company such as HSD based upon its asset values alone? Why should you be based upon its asset value alone? All right. What type of company is HSD? That is the whole issue. They told us that HSD is a well-listed, unlisted, with a strong reputation for the quality of its staff, right? So, all right, so let's see what's here. A, the market value are likely to increase. Okay, that is not why it's not appropriate. That's why it's appropriate. B, a large part of a service company's value lies in the skill and knowledge of its personnel. That is true, because that's what they're known for, right? Their staff. That's what they're known for. So B as in boy, that would be the answer for question 28. Question 29. What is the valuation of HSD using dividend valuation model? Number 30 is theory. Let me go at 29 and just go straight to how our workings are. Okay, last year's dividend was 360,000, cost 30 cents, 1.2 million share. A 3% increase next year would be 370,800. That's what a 3% would be. So using the dividend growth model, right, assuming constant growth of 3%, it would be the 370,800 over the, so it would be D over KE minus G. So it would be the 370,800 over 0.13, the KE minus 0.03, which is the G, giving you 3.708 million. So C would be the answer for question 29. Question 30 is theoretical, where it says the use of the dividend model to value is based upon a number of assumptions. Which of the following is not one of these assumptions, right? Which of the following is not one of these assumptions? So the current year dividend does not vary significantly from the trend. Okay, that's fine. Future dividend will continue to grow at the same rate as they have done in the past. Oh no, that's a problem. The cost of equity can be reliably estimated. That's okay. Investors act rationally. Yes, A, C, and D are correct. So B is what you should have your answer. That's not one of the assumptions. B as in boy, That's what you should look at regarding question 30. Okay, so read PLK and we're going to just go through the critical parts of PLK. Similarly, for fly high, right? So read PLK, give it some minutes to read it, to start some workings. Then we're going to discuss PLK and then fly high.